Welcome to our Taking Stock video for the week ending the 1st of March 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Equities Analyst, Charlie Song, to stream to your thing share market. Great to have you on here for the first time, Charlie. How are you feeling?
Yeah, great. Thanks, Ken. I'm excited to join you.
Great to have you on board. But before we get started, just a quick yet important reminder, the information we provide today is of a generic nature and therefore doesn't take into account your personal situation. Remember, shares are volatile, so any past performance figures shown today shouldn't be relied upon as a guide for future performance. Well, Charlie, another reporting season has ended, and it's been a great one for quality stocks. In fact, over the last month, our star growth stocks have generated a return of 5.3%, well above the market of around 1.2%. And the contributors to the performance came from Altium with its potential takeover and better than expected results from WiseTech, Macmillan Shakespeare, and RPM Global, which all returned in excess of 20% over the month.
Yeah, that's right, Ken. We have done quite well. But over the reporting season, we've also noticed quite a bit more speculation and a lot more market froth. A lot of financially weak stocks have really rallied. A lot of these stocks are unprofitable, and it does feel like a tech bubble of sorts. One stock we would pick out in particular is NextDC, which is currently rated in early warning on our financial health model. The stock operates data centers and has rallied strongly off the back of strong demand and constrained supply of data center supply. So the problem you can see here is under Golden Rule 4, earnings continue to trend lower as interest costs rise. And so despite that, the stock price has obviously trended in the other direction.
Yeah, very interesting. The renewed popularity of AI stocks is driving some of the speculation as well. But in fact, if you take a look at the earnings trend for the market over the reporting season, we can see a distinct divergence between the market index, and that's in blue, compared to the earnings trend, which is in black. Yet share prices have continued to test its highs, hence why it's now more important than ever to really assess your portfolio to ensure you hold on to stocks with those strong fundamentals. As Warren Buffett once said, it's only when the tide goes out do you discover who's swimming naked. And given that it's the end of the reporting season, we'd like to now turn our attention to a few star stock highlights for the week. We've decided to remove health insurer NIB Holdings from our borderline star growth stock and star income stock portfolio. And although the outlook under Golden Rule 3 shows positive earnings growth, our analyst, Ryan Lyng, he has highlighted the risk that could potentially lead to a rapid compression with its insurance margins. And he also spoke about industry data from APRA suggesting claims inflation may be tracking ahead of expectations. Meanwhile, with CPI-linked premium rate increases, that's forecast to slow on the back of lower inflation. So there's high earnings uncertainty, and what that means is that dividends become less stable and could be revised lower. The stock is currently on a gross dividend yield of 6% and is expected to go ex-dividend on the 7th of March.
Yeah, and amongst his peers, despite the fact that Medibank has what looks like a higher dividend yield, we're not so sure on the company because, as you mentioned, there are a lot of heightened risks with regards to cybersecurity and regulatory scrutiny, which we think will be material to earnings in future years.
Yeah, if you have any questions on that, please contact Ryan. But during the week also, borderline star growth stock and building restoration business, Johns Lyng, they reported their results, which appear quite solid, upgrading their financial year 24 guidance by about 5%. But the share price dropped by about 13% on the day. What happened here, Charlie?
Well, clearly, upgrades or downgrades sometimes don't translate to share price movements. And it's not the first time we've seen this happen, especially with Johns Lyng. We understand that the business doesn't really guide for catastrophe work, which is something that they can't really predict given that it's based on natural disaster activity. So really, the reason why Johns Lyng fell and saw that share price weakness was due to a multitude of factors, really. Firstly, there was no growth in the US business. Now, the US business is where investors are looking for growth. The Australian market's obviously a bit more mature. So the fact that you have this new growth segment that isn't growing, well, that's a concern, right? Secondly, the losses within its commercial construction business also accelerated. If we include this loss within the earnings, then the result is actually quite below market expectations.
Yeah, very interesting, Charlie. And this could potentially impact the outlook forecasts and earnings revisions for the stock. Johnson Lyng does have a good underlying business, but we do believe that the market opportunity in Australia here is becoming quite saturated and reliant on disaster activity. And the US business rollout has also stalled as well. It's currently under review, but we now question whether the stock is a true dynamic growth stock. Now, on to another disappointment during the week. Public transport operator Kelsian Group announced their first half 24 result this week, and it seemed like performance over the period missed consensus expectations. What led to the negative sentiment, Charlie, here?
Well, there's two headwinds that is currently Kelsian's currently facing. They're experiencing higher labor costs and high interest expense. High labor costs was quite well understood. We knew that wage growth was going to increase based on inflationary expectations, but interest expense was not something that was really baked into most analyst forecasts. And so when we saw that a lot higher than expected, that obviously now has driven some downgrades to FY24 forecasts on the earnings line.
Yeah, so the stock is currently under review as we assess whether those strong earnings growth outlook is still achievable. But on the resources front, I noticed that lithium stocks have begun to gain some traction due to elevated restocking activity post-Chinese New Year, and also reports of mine closures in China. But we have decided to cease coverage on IGO Limited regardless, Charlie.
Yeah, that's right, Kien. And Dan's been saying for a while his preferred picks within the lithium space are Pilbara and Mineral Resources. We obviously recommend members read the IGO key update where there's a lot of information, but also Dan's lithium article, and obviously talk to Dan and understand why he thinks those are the preferred picks.
Yeah, thanks for that. And looking now with the reporting season coming to an end, we don't have any star stocks reporting next week, although a few star income stocks are expected to go ex-dividend, including Coles Group, Endeavour Group, and also Helia Group. So look out for that. In Under the Microscope this week, we take a look at animal feed business and star growth stock and star income stock, Ridley Corp. Its result was in line with expectations, with the business generating annualized earnings growth of around 3.6% and a return on equity of 13.8%. However, the stock was sold down significantly. What was the reason for this, Charlie?
Well, the main reason is that macroeconomic conditions, what management's telling us that they look challenging. And what they're saying is that globally, we're seeing lower meal prices, and domestically, we're seeing lower tallow prices, with both of those are probably going to be headwinds throughout the second half of FY24. This is more commodity prices coming off elevated peaks, but we still think they're fundamentally sound and there is fundamental demand for these products.
Yeah, interesting, Charlie. Many investors look at Ridley and think that because it's in the agricultural space with commodity price influences, its earnings can be quite volatile. Why do you think this isn't the case?
Well, relative to other agricultural players, I don't think Ridley's really as volatile as you might think they are. And the reason is that I believe that most of their earnings are actually much more levered towards volume and volume growth. And that's largely through their bulk feed segment. And they're less exposed compared to maybe Elders or Inghams through commodity pricing. Additionally, the company is well diversified across a number of animal species. Also, cyclicality in the supply cycle is offset by supplementary feeding cycles. So when there's dry weather conditions or there is wet weather conditions, that sort of might benefit one business segment and might be a weakness in another business segment, and that sort of offsets each other. So for example, in dry conditions, there's more slaughter of cattle, which results in more tallow and a decrease in tallow prices. But this is offset by increased demand for livestock feeds.
Yeah, very interesting. But many investors also may be looking at Stock Doctor and they look at the net profit margins, which is quite low. Does the business have a competitive advantage here?
Well, competitive advantages are really built through high barriers to entry. And I think any business trying to enter the animal feed industry is going to face very high barriers. The reason is you have to build up a minimum efficient scale in order to achieve profitability. And so obviously new entrants would have to be unprofitable for quite a while in order to do that. Economies of scale also mean that as Ridley really increase their volume and process more and more animal feed, they experience what we call operational leverage, which means that their earnings, the cost of their fixed assets diminishes as a proportion of their total sales. And so that's one competitive advantage they have. But another they have is that there's physical barriers to entry that require feed mills to be relatively close to their points of destination.
Right. And despite those macroeconomic conditions, which are quite challenging for them, I guess, looking ahead though, what's driving the positive earnings growth there?
Well, I think positive earnings growth will be driven by margin and volume expansion, with market share gains really less reliant on pricing growth and commodity prices in general. In addition, there's going to be benefits and earnings contribution from that acquisition of oceanic meat processors. And so that and further acquisitions I expect will contribute to growth.
Okay, so this looks like a case where volatility can create opportunity, and the stock is currently trading at a discount to its fair value. So just beforehand, though, are there any risks investors should be mindful of here?
Well, I think investors should probably be mindful that mill prices and domestic tallow prices could fall further than management and analyst expectations. Additionally, any sort of large-scale culling of Australian herd volumes would definitely be a negative impact on the company.
With the reporting season coming to an end, a useful question for members now is how can Stock Doctor help you look for star stock opportunities? Well, investors can look for these opportunities by using the stock filter, which lies under the Tools tab. Here you can build your own filter or select from a list of predefined filters such as star growth stocks or star income stocks.
Yeah, and there's a few filters that might be useful. You might want to use EPSG 1 year forecast. You might want to use price change 6 months, maybe a technical indicator such as SD30 TSR, or you might want to use your 1 year total return, price to consensus target for all the value investors out there, and EPS forecast 1 year, 3 month revision to understand which businesses really have momentum.
Yeah, and then you can sort the list by 3 month earnings revisions. But in general, upgrades to earnings estimates means that the stock performed well during the reporting season. And to look for opportunities, just filter stocks with stable or rising earnings revisions and either have breached the SD30 TSR or have generated a negative or flat return over the last 6 months. Or you can look for companies with strong earnings revisions but are trading at discounts to consensus share price targets.
Yeah, and some of these companies, you might want to be looking at include Endeavour Group, ResMed, Challenger, and CSL. If you're a resource person, maybe you want to be looking at Lynas, Rare Earths, Alkane Resources, or Mineral Resources. But remember, there is risk with underlying commodity prices, and those sometimes aren't captured by these filters.
And for income investors within your filter criteria, you could also include gross dividend yield forecast, franking forecast dividend payments, and also days to ex-dividend dates. Here, sort companies by the highest gross dividend yield and look for those with upcoming ex-dividend dates. Some opportunities here include Helia Group, Macmillan Shakespeare, Super Retail, and Endeavour Group and Coles.
Yeah, and I'd also recommend running these filters outside the Star Stock universe. Obviously, there's a whole bunch of other companies out there which can provide a lot of opportunity. So over the next few weeks, we'll be looking at a lot of companies as potential inclusions, and there will be initiations on the way. So watch out for those.
Yeah, thanks, Charlie. And feel free to give our team a call if you have any questions. Otherwise, you can attend our Lincoln Live webinar on Monday. That's all we have time for today. Again, thanks, Charlie. And I know you've been very busy with reporting season.
Yeah, I have. There's a lot going on in my sector.
Yes, and just a reminder about Masterclass. That event is in April, where Tim, myself, Matt Swartz, and Daniel will be providing members with a personal learning experience to help you master Stock Doctor and maximize your membership. So there's only a limited number of tickets available, so make sure you reserve them as soon as possible. In the meantime, take care and have a happy, healthy, and prosperous week ahead.